Hi, I'm Kevin Ramirez with AAA Mortgage Training, and welcome to part 6 of my teaser for my NMLS class. I offer the official NMLS pre-licensing 20-hour course, which is required course to become a licensed loan officer. And I want to give you a taste of the experience of being in my live webinar so you can see my energy, how much fun we have, and of course, my little bit of a unique angle, which is a bit different than some of the less expensive self-paced options out there. So make sure you check the chat for the link and how to register for my class. And let's get started with part 6 of our teaser here. So today I want to also focus on TRID, which has also been called Know Before You Owe. So this is very popular. People always wondering, hey, Kevin, does your class cover TRID? Need to know TRID? Well, simply, TRID stands for TILA RESPA Integrated Disclosures. Well, it kind of comes from TILA and RESPA are two separate laws. If you look through my other series, my other teaser part series, RESPA, Regulation X, and TILA, Regulation Z, they're still separate laws, but there was some overlap. In fact, some of the disclosures were a little redundant between TILA and RESPA. And so they said, you know what, why don't we streamline this process, make it a little easier? And it was more of an initiative. So TRID is not an act or law per se. It's more of an initiative where they say, you know what, let's take some of these disclosures from TILA, some of these disclosures from RESPA, and integrate them and have less disclosures. With that came some extra rules around those disclosures and so forth. Well, let's take a look here. It was designed to help consumers with information towards understanding features, costs, and risks of the mortgage they're applying for. Okay, so it did happen. Time flies. A good 7 years ago, at the time recording this, October 3rd, 2015. I don't think the test is going to ask you about the date, but that's when it kicked in and was a big change for a lot of us in the industry. TRID consolidated several existing disclosures under TILA and RESPA into two forms. In fact, I'm going to show you the next page. There's even more than this, but here's a little sneak peek. The loan estimate is what you would write in. If you're taking my class, I would have that for you on the screen. Replaced RESPA had something called the good faith estimate, the GFE. Now, I shouldn't talk about in the past tense. RESPA's good faith estimate still exists, but most home loans that you're going to be dealing with do not use the good faith estimate disclosure anymore. Uh, and it also replaced TILA had one called the initial truth in lending disclosure, which again still exists for some loans, some home loans. TRID does not apply to. So we'll talk about in just a moment. But the loan estimate replaced these two major disclosures. A couple others I'll tease about in just a second. Then there's also the closing disclosure, right? The loan estimate is sometimes called the LE, and the closing disclosure is sometimes called the CD, okay? So this replaced the closing disclosure. RESPA had something called a HUD-1 or HUD-1A settlement statement. It was like the final invoice of the loan. So you get an estimate up front and you get the final invoice when the loan is at, closing. So that again still exists for non-TRID loans, which most loans TRID does apply to. And RESPA had a TILA had a final truth lending disclosure. So again, they had initial one and a final one, but most loans that where TRID applies to, you will not see these disclosures anymore. So kind of nice little visual for you here, how these two became these two and these two became this one. Okay, next page here. Now I just teased about it. There are some loans that are called TRID exempt loans. TRID does not apply to. Okay, the following loan types, they still use the good faith estimate, the HUD-1 or HUD-1A settlement statement, the truth in lending disclosures, such as reverse mortgages. Reverse mortgages, which we teach about in our class, that's usually for the elder folks, age 62 and above, right? It's a unique loan for elder folks that have a lot of equity in their homes. Well, they don't use TRID, so TRID does not apply. Those TRID disclosures, loan estimate CD does not apply. HELOCs, home equity lines of credit, a unique type of home loan, often a second mortgage. Again, TRID does not apply. And certain down payment assistance programs, call them DPA programs, or exactly what it sounds like. There are various organizations out there that offer either grant money or loans in the form of down payment assistance. TRID does not apply to this. So let's talk a little bit more about this loan estimate, the LE. Well, what is the LE? And how do you put one together? Well, think about it. This aren't our first rodeo, right? Every time we do a loan for a customer, we usually done a loan before for in that state or in that area. So we have a general idea of what closing costs will be for the customer. So we should be able to put together an estimate what those fees will be up front, even before a customer is locked in the loan, okay? Locked in an interest rate for the loan. So the purpose is an upfront estimate of the cost at closing. Okay, so it's again, an upfront. So I always say it like this. It's if you drop your car off at the mechanic, they give you an estimate. That's like the loan estimate. And then you go pick up your car from the mechanic and you get the final invoice. Well, that would be the closing disclosure. Same kind of concept there. The loan estimate, LE, helps borrowers understand the key features and costs of the loan. It is, I think it's a little bit easier on the eyes. So good job to the lawmakers there. Made it a little bit easier to read. And the lender is responsible for issuing the loan estimate. Now, that sounds obvious. Why am I even saying that? Well, because we do know, if you take my class, there are such thing as mortgage brokers, right? A unique type of model which acts as an intermediary between a borrower and a lender. So, or what I'm emphasizing here is if a mortgage broker is involved in a transaction, well, who's responsible for giving the loan estimate? The lender is. Just making that clear for you here. So, a little bit more to the story I just teased about a moment ago. The loan estimate replaced more than just those two docs. So, RESPA has, as we know, the good faith estimate, the GFE. We talked about that. It still exists for the TRID exempt loans, right? But on top of that, RESPA has something else called the servicing disclosure statement. Now, this is disclosure, which I teach more about in the class, but the little tease on it. It tells the customer, hey, you know what? I'm glad you love me, but don't get too attached because there's a very good chance I'm going to go ahead and sell the servicing of your loan later on after the closing funding settlement of the loan, right? So it's good to tell the customer up front, as some customers are pretty big on that, usually more of the old-fashioned folks, okay? Now, TILA's initial truth in lending disclosure, right? The initial one anyways, it replaced that. And then one, ECOA, that's the Equal Credit Opportunity Act, Regulation B. If you've watched my teaser videos, B equal. Well, they have something called the right to receive a copy of the appraisal disclosure, which is exactly what it sounds like. Hey, Mr. Borrower, we're going to be doing an appraisal on this loan. And if we do one, you have a right to receive a copy of that immediately, blah, 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 right? So we don't need all four of these disclosures for TRID loans or loans that are under TRID because the loan estimate covers all the language and verbiage disclosure to the customer. So there you go. So 4 different disclosures. For TRID exempt loans, they will still use these 4 different disclosures. Now, loan estimate details. We have to list all known settlement charges, which is, again, closing costs. Now, again, all known. I just mentioned this is not our first loan. So we've done loans before. We have an idea what's going to be needed, title, if not escrow, this fee, that fee. So we have to list those up front. We cannot hide it. Bait and switch is gone, thankfully, to you loan officers there. When I was selling loans, and unfortunately, all my competitors were lying through their teeth, and it was very hard to be the honest person when everyone else is lying and telling customers what they want to hear. Well, TRID and all these laws have done a great job now of saying, hey, up front, we have to list all these known settlement fees. And if later on you forgot a fee that you should have known about, you should have had up front, well, guess what? You, the lender, will have to cover that cost for the borrower, which I think is fantastic. No more of that bait and switch nonsense that existed in our industry a few years back. I say this with pride because you could say this with pride. Makes me prouder of the industry we work in versus the shenanigans that used to happen there. So obviously, not all fees are known up front, though. Sometimes as we progress and we pull title to the property, we find out about different things. Well, you know what? We didn't know about that, right? We didn't know about that up front. So it's an additional fee, and that's allowed because we had no way of knowing that until we got to that certain point of finding that information. So the loan estimate discloses if the interest rate is locked or not, because as we work on the loan, we lock in the interest rate as we're working for 30, 45 days on the loan, right? We don't want the rate popping all over. So it'll disclose that, and also the cash to close required. So on a refinance, many times the customer's lucky. They don't have to bring any money to the closing table. We are able to use their equity and roll the cost into the loan. On a purchase, you cannot do that, right? Most of it anyways. Most fees cannot be rolled into a purchase transaction. So the customer has to come out of pocket with money for the closing costs, money for the down payment. It's expensive and it's hard to get into a loan with a purchase, right? You have to save a lot of money there. So this loan estimate will upfront tell the customer an estimate of what they can expect to bring out of their own pocket to make the loan transaction, the whole real estate purchase transaction work, if not also refinance. Sometimes we don't have the equity on refinance and they do have to bring some cash to close. Well, the loan estimate compares payments before and after mortgage insurance is in place. This is fantastic. Many customers hear the words PMI, mortgage insurance, they flip out. Oh, nope, 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 not going to do that. Cancel my loan. I know how it is. I've heard the horror stories. You can't get rid of it. Well, there's something called the Homeowners Protection Act. We'll cover in my class. but it helps the customer feel confident, like, no, you can see right here in paper, sir, your PMI will be for this many years, and then right here it shows it falls off, so you know it will not last forever. There's a law for that, making sure it comes off. So I think it's great. It helps you as a salesperson communicate these ideas to the customer. It displays something called TIP, total interest paid, which is very interesting. I've not heard a lot of customers talk about this, but it's kind of a scary thing. It's just right up front on third page of the loan estimate. It calculates the total interest paid over the life of the loan expressed as a percentage. So if you're going to borrow 300,000, you know over 30 years you're not paying 300,000, you're paying 300,000 plus all that interest from the interest rate, which is hundreds of thousands of dollars. So they express it as a percentage, like, oh, you're borrowing this much, you'll be paying back 70% of that on top of that in interest. So kind of a scary number there, but now you know how to explain it for the customer. The loan estimate tells them that up front. There's various sections of the loan estimate. I'm just going to talk about a few real quick. Section A of the loan estimate, right, is located at the top, and it shows all the origination charges, like the lender's fees, right, the discount points, the cost of doing business with that customer, an application fee. Okay, so and also Section B. Section B on the loan estimate, the LE, is the location of fees the borrowers cannot shop for. So there's certain things, the bar, unfortunately, it's a conflict of interest. You can't say, well, I'm going to go get my own credit report. Well, they can, but we can't use it in the home loan. Or appraisal. My sister's an appraiser. No, that's a conflict of interest, right? You cannot shop around for that. Or PMI companies, no, we pick the PMI company, the lender. So because these fees cannot shop, they're in Section B. And the reason for that, as I cover in my class later, is each section has different rules of how much these fees can or cannot change throughout the life of the transaction. So it's very important to know, again, to help eliminate bait and switch tactics, which were so common before. And Section C on the LE is the location of the fees the borrower can shop for. Again, some things they can. You know what? Oh, your brother works for, a friend at a title company has a great deal. Sure, right? Go ahead and use that title company or escrow company or various other services. So these are all broken out in the loan estimate. And again, it's very important for the customer to know that we have to know certain fees can change in certain sections and certain fees cannot. Well, I'm going to stop right there for my teaser of the loan of my course here. Look out for part 7. I'm Kevin Ramirez with AAA Mortgage Training. I look forward to helping you out, guys. I think you get an idea. This is, in my opinion, this is the way to learn so you truly understand the concepts, not just to pass the test. That's important, but I want to make sure you're lined up to really know how to be a strong, intelligent loan officer in this industry. Okay? Take care. I'll see you soon.